Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from Ecora Resources PLC. Before I introduce our speaker, a few points to note. Please submit your questions in the question box to the left of the slides. If you are interested in scheduling a meeting with Ecora, please click on the Meetings tab found on the left navigation bar. You will be able to view the company's availability and submit a meeting request. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome Kevin Flynn, Chief Financial Officer of Ecora Resources PLC, which trades on the OTCQX Best Market under the symbol ECRAF, and on the LSE as well as the TSX under the symbol ECOR. Welcome, Kevin.
Thank you very much. Thank you for the introduction. Thanks, everyone, and thank you for all of those online for your interest in Ecora Resources. There obviously is a pathway towards submitting questions. I'd really encourage you to do so. These sessions tend to work best in my experience when there's good interaction between host and audience. Going up 10,000 feet, what is Ecora Resources and what's our business model, I suppose, and what makes us really unique, in our opinion, is that we provide shareholders and stakeholders with exposure to the energy transition, but in a much more de-risked business model. And that business model is through the royalty and streaming concept. I think we would all probably accept that the world requires a lot more mining of key strategic minerals in order to achieve decarbonization and climate change targets. And at Ecora Resources, we support this journey through financing the production of those commodities that we consider key to this decarbonization journey. At its very simplest, a royalty is the provision of upfront finance to a mining operation, and in return, we would expect to generate a small percentage of the top line revenue generation once that mine has reached production. So as a feature in the capital structure, we sit somewhere between debt and equity, more probably aligned to equity in that we take very similar risk exposure in terms of our returns being generated at the point that the operator is in production and generating cash flow. Each contract that we have historically negotiated is very bespoke and can be very flexible, and in that regard is very friendly to a producer vis-a-vis something like debt, which can have fixed amortization profiles and covenant restrictions and requirements, etc. So at Ecora Resources, we've been on a journey ourselves. Not only are we positioning ourselves to be very closely aligned to the energy transition, but our legacy began as a metallurgical coal royalty company. And in around 2014, 2015, we made a very conscious decision, perhaps quite early actually, to identify that the world was going to require a lot of commodities such as copper, nickel, vanadium, cobalt, etc., in order to pivot towards that 1.5 degrees Celsius world that we're now targeting. What we've done is we've built a portfolio through the recycling of metallurgical coal cash flows. And to that extent, in the last 18 months alone, we've acquired $400 million of royalties, which are primarily in this field of copper, nickel, cobalt. And that's really positioned this business with a very strong growth profile going out into the middle of this decade. And we'll touch on that as we go through the slides. Importantly for us at Ecora, and what's a real differentiating factor for us vis-a-vis a lot of the royalty and streaming businesses that some of you might be familiar with in North America, we focus solely on future-facing commodities. Or to put it a different way, we don't invest or look for exposure to precious metals such as gold and silver. Our portfolio, we've got about 15 key royalty and streams in our portfolio. the vast majority of which are in what we describe as OECD jurisdictions, but more importantly, jurisdictions that prioritize their mining sector as key to their economic prosperity. Our strong growth profile is something we'll touch on later, but our latest acquisition, which was a 185 million acquisition of a portfolio of royalties from South 32, provides us with some very tangible growth opportunities in the middle part of this decade. And that really adds a different dynamic to our equity model, which hitherto had been very much focused on producing royalties and a strong dividend yield as such. I've been with the business now 11 years, and I think we've proven a very successful track record over that period. There is a slide on this, which we can touch on later as well. But more importantly, whilst we are targeting supporting the supply of these key and critical minerals to the energy transition, we're doing so in a way that will only support those projects which have very robust sustainability profiles. And I think our track record to date in supporting these through the jurisdictions that we've looked at really backs this up and should align the Ecora business model towards what's required for the world to really achieve meaningful decarbonization and the provision of sustainable energy going forward. At the bottom of the slide, you'll see the chart, which shows at the beginning of this journey, we were basically exposed completely to metallurgical coal and 0% to these future-facing commodities. And once we expect our metallurgical coal exposure to fall off in 2026 or thereabouts, we'll be left with a portfolio that basically at that point has about 90% exposure to these future-facing metals. And that, we believe, is one of the most noticeable transitions in terms of a business going from a perceived fossil fuel legacy towards one that's meaningfully transitioning and pivoting its business towards future-facing commodities. Looking on the next slide, I won't dwell on this. I think most of this has been kind of covered off already, but what's the investment case for Ecora Resources? Well, we think it's a compelling commodity and sustainability profile. I think, the world is beginning to accept that mining is a key part of the solution and not part of the problem of achieving climate change objectives. We offer a de-risked exposure to the mining sector through the royalty and business model. And as I said previously, this exposure is through top-line revenue. So investing in Ecora Resources, you're getting exposure to a basket of commodities pivotal towards achieving energy transition, but at the top line, which means you're getting exposure to the commodity price without the operational drag and margin erosion that we're currently seeing in the sector as inflation runs rife. And that's a very powerful defensive position the royalty and streaming business model provides. We've now positioned our equity story to provide shareholders with meaningful medium-term growth prospects. Again, we'll touch on this in a couple of slides. Very importantly, we've got a very strong balance sheet at present, which means that in order to finance our growth ambitions, we now have ready access to well over $150 million of liquidity to continue our growth journey. And that's in addition to the $400 million of growth that we've already put into the business over the last year and a half. Ecora Resources is a leading dividend royalty and streaming business in the royalty universe. Our current equity provides shareholders with a yield of approximately 4.5% to 5%, and that's noticeably sector leading. And we've got a management team with a proven track record of delivering growth throughout the last decade. Looking on to the next slide, and again, I think I've covered a lot of this already in terms of what our vision and our strategy is. But for Ecora, we see a position in the market whereby the royalty and streaming sector has traditionally been dominated by large organizations exposed mainly to precious metals. And we think we fit a unique position in this and a gap to create a royalty and streaming business of scale, offering stakeholders exposure to base metals and key strategic minerals, pretty much aligned to the energy transition. And our objective is to continue the growth strategy that we've now well and truly got underway, to build on that momentum and to continue growing in a disciplined way to achieve the scale and rating that we hope we will be able to achieve in time. The next slide really is included to show what our understanding of the real size and scale of our universe will be. If we look at the metal intensity of just the automobile, for instance, on the left-hand side of the left-hand chart shows you the metals required in the conventional combustion engine vehicle. And on the right, you will see what's required to be for the construction of electric vehicles. And in terms of those commodities that are required, copper, nickel, cobalt, lithium, our current portfolio provides exposure to most of these at present. On the right-hand side, we can see that clean energy is really dependent on mineral extraction, whether that's in the infrastructure or indeed the means of storing the energy generated through solar, onshore wind, and offshore wind. And again, I mean, similar thematic, both of these require significant quantities of copper, nickel, zinc, cobalt, lithium, etc. And at present, it's generally acknowledged that there just simply isn't the visibility on the future supply of these commodities to meet the expected demand in order to achieve this transition. Looking on to the next slide, which kind of continues that theme in an illustrative way. And this just shows how the commodities that we're specifically targeting and investing in really kind of fulfill and fit in with every step along the way of creating a cleaner and sustainable energy model, whether that's from the generation of energy, the storage of energy, or ultimately the transmission of energy. There are significant amounts of copper, nickel, cobalt, etc. required to achieve this. And if we look at the right-hand part of this page, we now have greater than 75% exposure by balance sheet value to base metals, vanadium, uranium, which are key kind of inputs into this journey. Looking at our geographic exposure, and to back up the point that we made at the beginning of this presentation, 95% of our asset location is in OECD jurisdictions. 41% North America, 30% South America, 26% Australia, for instance. And we think that's a very compelling model in terms of providing a de-risked exposure to commodities through the top line generation in a diversified way, but also in jurisdictions that are traditionally known to be safe mining jurisdictions. Then in terms of stage of development, if we look at this donut, the final donut on the slide, about a year ago, this would have looked very, very different. We would have had close to 90% of our portfolio represented by producing assets. We made a change during this year, buoyed by exceptional levels of windfall coking coal cash flows that our portfolio was generating, to recycle and capture those cash flows and specifically reinvest those into growth, tangible growth opportunities, which should come through in the middle to later part of this decade. So now we feel our portfolio is much more balanced in terms of its exposure to producing assets, but with some very tangible growth prospects as well to come through, as our coal asset winds down and moves outside of our private royalty area in 2026. The next slide really shows our commodity exposure, but also those commodities we're targeting. And I think I won't dwell too long on this slide because we've covered off a lot of this previously in terms of what we're looking for in terms of copper, nickel, etc. But the items on the left-hand side, without being boxed in, are the ones we don't have exposure to, and the ones we continue to look for exposure to complement the portfolio that we've already created. The next two slides, I think, are a snapshot of our portfolio. I won't go into these in a huge amount of detail, but if we look at our producing royalties, for instance, some of these may be household names for some of our audience today. We've got exposure to Vale, we've got exposure to Capstone Copper, Rio Tinto and Largo as operators and those who pay our royalties. And as you can see, these royalties that are in production are in Australia, North America, and South America. A similar kind of story on our development pipeline, where we've got exposure to some world-class assets, Oz Minerals, West Musgrave, and Santo Domingo from Capstone Copper. These are assets we acquired in June this year, and we expect those to certainly be in production by the mid to latter parts of this decade. And looking further out, we've got some very interesting projects afoot at Piauí in Brazil. We've also got exposure to the Ring of Fire in Canada, operated by Wyloo. We've also got some iron ore exposure in BHP's Pilbara area as well. So there's other assets in our portfolio, but these are the key ones, and they really create the path, if we move on to the next slide, to show where we consider our growth in terms of revenue to come from by the end of this decade. On the left-hand side, you will see that our Kestrel, this is our representative of our hitherto cornerstone asset, which was our Kestrel metallurgical coal royalty in Australia. On average, this royalty has generated $42 million over the last 5 to 6 years. Our existing portfolio and already those income-producing assets in our existing portfolio, excluding this Kestrel asset, already generates or is expected to generate more than what our Kestrel royalty has generated. The optionality that we have in our portfolio, the green box, is expected to produce between $15 to $20 million of additional revenue. And our most recent acquisition, the West Musgrave and the Santo Domingo royalties that we acquired for $185 million in July this year, could generate between $30 and $50 million as well. So if we add up the right-hand side of this page, that creates a path towards a portfolio that could generate north of $100 million, excluding our Kestrel royalty, by the mid to end part of this decade, positioning this business for some meaningful earnings and dividend growth to come as we move forward. Our investment criteria, I'll touch on this very briefly. We've been very, very disciplined in terms of how we approach our investments. This has generated a successful track record, but basically what we look for: good jurisdictions, projects that are expected to be low on the cost curve, within our return criteria that we look for, in those commodities that we think are going to be key to creating a sustainable future, with some very good supply-demand fundamentals backing them up. But ultimately, all of this has to have key ESG risk assessment criteria at its heart, because we believe that it's those projects that are operated in a sustainable way, generating sustainable energy with full local involvement from communities, are those projects that are likely to endure and ultimately be successful over the course of time. In terms of our track record, on the right-hand side, you'll see our 5 most recent acquisitions, what we paid for them, the income they've generated to date, and what the expected street consensus NAV is. And that shows a pretty attractive return on capital threshold that's pretty transparent and can be judged by investors objectively. And this doesn't include the recent South32 portfolio that we've acquired, but even within that portfolio, we've seen some very meaningful growth catalysts from those two main assets come through recently. Just conscious of time, I'm just going to wrap up with two final slides, if I may. In terms of capital allocation, this business has never been better capitalized. We've got a $200 million growth facility through three of the leading lenders to the royalty and streaming sector globally: Scotia, RBC, and CIBC. In terms of our net debt, this is currently sitting at around about $40 million at the end of Q3. So we've got a strong balance sheet. We've got ample liquidity, which means that we can transact opportunistically and quickly should opportunities present themselves. We've got a quarterly dividend of currently 1.75p per share. This is pence. Our stock is listed in London. This is around 9. So this equates to a 7p annual dividend, or 9 cents per share in US dollar terms. This is paid on a quarterly basis. And as I said previously, this is most definitely sector leading amongst diversified royalty and streaming businesses. So finally, to wrap up on Ecora and what makes this investment proposition quite unique and compelling in our opinion, we're a business that is on a journey, transitioning towards a business fully aligned to the energy transition by taking metallurgical coal royalties and recycling those into future-facing commodities. We've got the balance sheet, we've got the liquidity to support our growth initiatives. We're insulated from inflationary pressures because we operate at top line, so we're not exposed to margin erosion that is impacting significantly on the mining operators. We've got some very tangible medium-term growth uplift and prospects in our business through the West Musgrave and Santo Domingo royalties. And longer term, we're just exposed to a very strong thematic in terms of a supply-demand outlook for commodities such as copper, nickel, cobalt, vanadium, where the future demand of these commodities for use in the energy transition is expected to far outweigh the current supply profile. So we feel we're in a very good position, and this stock should resonate very well with shareholders who are looking to get exposure to the sector without necessarily having to take asset level risk through an operating business. And that's effectively our USP. I'm joined by Rachel Dare, our Head of Communications, who will help me go through some of your questions. Thank you for listening to the presentation, and hopefully we can see some questions coming through. Thanks, Rachel.
Thanks, everyone. So our first question: is the company going to convert entirely to reporting in US dollars, including dividend and any hedging?
So the answer to that is we currently report our results in US dollars. That is our functional currency. We have said that we are going to look to transition our dividend to a US dollar metric as well. That is something that's under review. In terms of currency hedging, we still have a portion of our income derived in Australian dollars, but that is expected to begin to fall off as we go through next year and our coal royalties commence winding down. So yes, there are plans afoot to convert ourselves more towards a USD denominated business.
Okay, question number 2. Do you have a strategy to improve liquidity on the Toronto Stock Exchange?
I mean, in an ideal world, we would have a lot more liquidity on the TSX. I think in the short term, there are two things which within our control here. One is the deals we continue to execute on. And the second is the communications program and the presence and profile that we create in Toronto. I think ultimately, a solution to the TSX liquidity is going to have to be a capital issuance or some other form of acquisition that we undertake. So it'll have to be specific around an acquisition. In the meantime, we're going to continue to push the story and hope to convert shareholders who are able to hold the stock on the TSX.
Okay, another question. With the US funding expansion in lithium batteries, is this a commodity you're looking to add to the portfolio?
Yeah, lithium is an obvious gap in our portfolio. I think if you look back to the slide, we don't have a box around lithium. I think it's sometimes when commodity prices for one commodity runs very hot, it can be very difficult to acquire an asset or have conviction in the long-term price. I think that's the good thing about Ecora. We can move laterally across commodities in a way that some precious metals, royalty, and streaming businesses can't do. But look, lithium is on the watch list. It's something we would consider getting exposure to. But given the dynamic of the lithium market right now, it's more likely than not that would be at a non-producing stage than a producing asset opportunity.
Okay, next question. How competitive is the royalty and streaming sector for battery tech metals?
I mean, of course, there's competition, but I think we've obviously deployed $400 million recently. So I think that's sector leading outside of the precious space. By and large, the non-precious royalty and streaming sector is much less competitive than the precious metal space. And I think that's just reflective of the progress that we've made over that period of time. We're not complacent. We think we're the incumbent in this space around energy transition, and we continue to see meaningful opportunities to grow and add to that portfolio, and that's fully the focus.
I think we might have time for one more question, and somebody's just asked if you could expand on the relationship we have with South32.
We've got a great relationship with South32. We acquired their base metals portfolio early on this year, and they became a 17% shareholder in our business through that transaction, which obviously demonstrates a very close relationship between the two of us. They have conviction in terms of the growth that we feel we can achieve in this business. But that's based on the track record that we were able to demonstrate to them as we went through that process. They're good partners. We look forward, hopefully, to doing more with them in the future.
Okay, we've probably got time for one quick question, just around the dividend. Somebody's asked, how often do you distribute dividends?
We pay on a quarterly basis. So that's very much the model that our shareholders in London here look for. And that's we pay that both on the London Stock Exchange and the Toronto Stock Exchange. So we pay a stable quarterly dividend at present, and there's no plans afoot to change that anytime soon.
Okay, I think we've answered all the questions.
Great, that's all the questions. Well, if I could conclude, thank you very much, everybody, for your interest. This is very much an introduction to Ecora. We haven't done a deep dive in terms of the assets. If anybody does have some follow-up questions, we are very happy and able to answer those, and look forward to hopefully presenting much more in future.